Picture this, you start a new job and on your first week HR slides a packet across the desk and says congratulations, you're automatically enrolled in the 401k. You nod, you sign, you feel responsible, you feel like you're doing the right thing. And every paycheck from that point forward, a percentage disappears before you ever see it going somewhere that's supposedly building your future. And then years go by, maybe a decade. And one afternoon you log into your 401k account and you start actually reading the statements for the first time. Not the balance, you've been watching that, but the actual details, the fund names, the numbers next to the fund names, the small percentages that don't look like much individually. And you pull out a calculator and you do the math that nobody sat down and did with you on your first week. And you realize that those small percentages that don't look like much have been quietly extracting thousands of dollars from your retirement account every single year. Not from your paycheck, from your returns, from the money that was supposed to be compounding for you. For decades, that moment, the moment you understand what has actually been happening inside your 401k, is what this video is about. My name is Lucaso, and I spend way too much time thinking about money, financial systems, and the very specific mechanisms that allow entirely legal structures to extract significant wealth from people who are doing everything they were told to do. If you have a 401k, or you're planning to get one, and you want to understand what's actually happening inside it, hit that subscribe button and give this video a thumbs up if it ends up saving you money. Quick disclaimer, nothing here is financial advice. This is purely educational. Let's get into the mechanics. Here is the number that should make you stop and pay attention: 1%. 1% doesn't sound like much. You see it and you think that's barely anything. 1% of my 401k balance per year? Fine, but here is what 1% actually means over a lifetime of investing, and this is the math that the financial industry has historically preferred you not do yourself. If you invest $300 per month for 40 years in a fund that returns 7% annually and charges 1% in annual fees, you end up with approximately $798,000. That sounds great until you calculate what the same investment would have produced at 0.05% fees, the level now available through index funds from providers like Vanguard and Fidelity. At 0.05% fees, the same contributions over the same period produce approximately $1,076,000. The difference is $278,000, extracted silently in fractions of a percent year after year from a retirement account most people never fully examined. And here is where it gets genuinely alarming. According to a 2023 analysis by the Center for American Progress, the average American worker pays approximately $138,000 in 401k fees over their working lifetime. Not in taxes, not in investment losses, in fees that never appear as a line item on your paycheck, fees that compound against you in the same exponential way that returns compound for you, silently, automatically. For decades, let's break down exactly how the 401k fee structure works, because understanding the mechanics is the only way to identify whether your specific plan is working for you or quietly against you. A 401k plan has multiple layers of fees, and most participants are aware of at most one of them. The first layer is the expense ratio. This is the annual fee charged by the mutual fund or investment option you're invested in, expressed as a percentage of your assets. A fund with a 1% expense ratio charges you $10 per year for every $1,000 you have invested. A fund with a 0.05% expense ratio charges you 50 cents per year for the same $1,000. The difference in the fund's actual investment strategies is often minimal. Both might track the S&P 500. Both might produce nearly identical returns before fees. The fee is the only meaningful variable, and yet the default options in many employer 401k plans are actively managed funds with expense ratios of 0.75%, 1% or higher because those funds pay revenue sharing to the plan administrators. The lowest cost options exist in the plan. They are simply not the default. The second layer is the administrative fee. This is what the company managing your 401k plan, the record keeper, the compliance administrator, charges for running the plan itself. These fees are often buried in what the Department of Labor calls the plan document, which most employees have never read. They can range from $10 to $50 per participant per year, paid directly from plan assets, meaning from your balance. The third layer, and the most invisible, is the revenue sharing arrangement. Many 401k plans are set up with plan administrators who receive payments from the investment funds offered in the plan, a practice called 12b-1 fees or revenue sharing. This means the funds available to you in your plan were not necessarily selected because they were the best options for participants. They were selected in part because they pay the administrator for being included. The conflict of interest is real, documented, and largely legal. Now here is the critical practical implication. Within almost every 401k plan, regardless of its overall quality, there is typically at least one low-cost index fund option. A total market fund, an S&P 500 fund, a target date fund with a reasonable expense ratio. The existence of these options in the plan is often required. The question is whether you know they exist and whether you have actively selected them. Most people default to whatever was selected for them at enrollment, and the default is almost never the lowest cost option. The specific fee threshold that research consistently identifies as the dividing line between reasonable and expensive is 0.5%. Above 0.5%. The compounding drag on long-term returns becomes significant enough that the choice of fund, independent of employer match, independent of tax advantage, materially affects your retirement outcome. Below 0.2%, you are in the range where fees stop being the primary variable and asset allocation becomes more important. Here is what most people completely miss about 401k fees, and this is the aspect of this conversation that I find most worth understanding. The fee structure is not primarily a financial design. It is a psychological one, and the psychological insight at its core is deceptively simple. People do not feel fees they never see. When you pay a $10 monthly fee for a streaming service, you see it on your bank statement. You make a conscious choice every month to continue paying it. You have the option to cancel. The transaction is visible, deliberate, and reversible. When a mutual fund charges you a 1% expense ratio, you see none of that. You do not receive an invoice. You do not see a withdrawal. What you see is a slightly lower return than you would have received at lower fees, and you have no reference point for what that return should have been. The fee is not deducted from your balance in any visible way. It is simply embedded in the reported return. Your fund returned 6.2% this year instead of 7.2%. You have no way of knowing that 1% went to the fund company unless you know to look for the expense ratio in the fund's prospectus. This is not accidental. The financial industry spent decades successfully lobbying against disclosure requirements that would have made fee impact transparent at the participant level. The 2012 Department of Labor Fee Disclosure Rule, which required plans to provide fee information to participants, was a significant step toward transparency that the industry fought extensively. Even after its implementation, the information provided is technically available but not presented in a way that makes the long-term impact viscerally clear to most participants. There is also what behavioral economists call status quo bias, the powerful tendency to leave default settings unchanged. Research consistently shows that the majority of 401k participants stay in whatever fund they were defaulted into at enrollment, regardless of whether that fund is the most appropriate or cost-effective choice for them. The default is not neutral. The default is a choice made by someone whose interests are not necessarily aligned with yours, and most people never revisit it. The data makes the stakes concrete. In 2023, the Employee Benefit Research Institute published analysis showing that 401k plan fee levels vary enormously across employers, with workers at large companies typically paying significantly lower fees than workers at small companies, simply because large plans have more negotiating leverage with fund providers. The median expense ratio at large plan participants was approximately 0.25%. At small plan participants, it was approximately 0.97%. Same investment objective, same asset class, nearly a full percentage point difference in annual cost, determined entirely by employer size, not by investment quality. A 2024 report from Morningstar found that target date funds, the most common default investment in 401k plans, ranged in expense ratio from 0.08% at the low end to over 1.2% at the high end. For a participant with a $200,000 balance, the difference between these two options is $240 in annual fees. For the same participant 30 years from retirement, with returns compounding at 7%, that annual fee difference translates to approximately $240,000 in foregone wealth at retirement. Separately, following the expanded fiduciary rule enforcement of 2024, the Department of Labor opened investigations into multiple 401k plan administrators for failure to adequately disclose fee structures to plan participants. Several resulted in settlements requiring plan sponsors to audit their investment menu and replace high-cost options with lower-cost alternatives, in some cases reducing participant fees by 60 to 70% through menu changes alone. So what do you actually do with this? 3 things. First, find your plan's fee disclosure document. Every 401k plan is required to provide one annually. It is called the 404A5 disclosure, and it lists every investment option in your plan along with its expense ratio. If you cannot find it, log into your 401k provider's website and search plan fees or fund expenses. Find every fund you are currently invested in and write down its expense ratio. Second, identify the lowest cost index fund option in your plan. Look for anything with index in the name: S&P 500 index, total market index, large cap index. Compare its expense ratio to your current holdings. If you find a significant gap, anything above 0.3 to 0.4% difference, you have identified the fee drag on your retirement account. Third, make the change. Log into your 401k account, go to investment elections and reallocate your contributions to the lower cost option. Then change your existing balance to match. The entire process takes approximately 50 minutes and has no tax consequence because you are moving within a tax-advantaged account. But here is the warning that most people encounter at this exact point and why they still do not make the change. They log into the system, they find the low-cost index fund, and then they hesitate. Because the fund with the 1% fee has a team of portfolio managers and a long track record and a reassuringly institutional name. And the index fund just tracks a number. It feels passive. It feels like settling. Research from Spiva, S&P Indices versus Active, shows that over 15 years, more than 90% of actively managed large-cap funds underperform their benchmark index after fees. The fee is not buying out performance. It is buying the feeling of active management, which the data does not justify. Your 401k is likely the largest financial account you will own for most of your working life. The fee you pay on it is likely the most expensive financial decision you make that you have never consciously decided to make. 15 minutes once changes that. And the math says that 15 minutes is worth somewhere between $50, 000 and $300, 000 depending on your balance, your timeline, and the size of the fee gap you close. If this gave you a reason to log into your 401k account this week, hit the like button and subscribe. We break down the real mechanics of financial systems every single week. And if you want to understand the right order to invest your money, including where the 401k fits, that is exactly what the next video covers.